Hello, and welcome to the 71st edition of the GreenWave podcast by Synergy International. I'm SYNI, your host, and today's pod is titled Hot Rocks, Cold Politics, Fervo's IPO and the Geothermal Money Signal. A geothermal company from Houston has just given sustainable energy investors something rare in the current US market, a clean power stock that opened hot, traded hard, and made Washington's fossil fuel bias look tired before lunch. The pressure point is simple. US politicians are trying to drag the energy debate backwards, while capital is looking at load growth, data centers, firm, clean power, and the very physical problem of keeping the lights on. For many of our listeners in Europe, Fervo Energy may still be an unfamiliar name. That's normal. Geothermal has spent years as the sensible cousin in the renewable energy family, reliable, quiet, technically useful, and usually missing from the big political fight because there are no turbines to shout at from a campaign stage. Fervo has changed that. This week, it listed on NASDAQ under the ticker FRVO after pricing 70 million shares at $27. It raised about $1.9 billion and then saw the stock open at $36, with Reuters reporting a valuation above $10 billion after the debut rise. Fervo is still at the edge of commercial delivery. It has a small operating project in Nevada, a much larger project under construction in Utah, major offtake agreements, and a huge drilling task ahead of it. Investors bought the future before the future has fully arrived, because that's what smart investors strive to do. For us at Synergy International, that is the proper story. The US equity market has looked at geothermal energy and decided that hot rock, if drilled well and contracted properly, can become an investable clean firm power category. That phrase, clean firm power, does a lot of work here. It means low-carbon electricity that can run when the grid needs it, rather than when the weather happens to be in a generous mood. Solar and wind remain essential, together with batteries and transmission. But data centers, utilities, factories, and 24/7 electricity buyers also need clean power that can turn up on a wet Tuesday evening in February. Geothermal has always had that appeal. The Earth does not clock off at sunset. The problem has been geography, cost, drilling risk, and a shortage of patient capital willing to take subsurface risk before the wells prove themselves. Traditional geothermal has relied on naturally occurring reservoirs of steam or hot water. That has worked well in places with lucky geology. Iceland, Italy, Kenya, parts of California, Nevada, New Zealand, Indonesia, Turkey. Useful, proven, limited by location. Fervo is working in enhanced geothermal systems, or EGS. The idea is to engineer the reservoir, drill into hot rock, create or improve pathways through the rock, move water through those pathways, bring heat back to the surface, and generate electricity. That is why Fervo sits in an interesting industrial lane. It is a renewable power developer using tools borrowed from oil and gas, horizontal drilling, hydraulic stimulation, reservoir engineering, fiber optic sensing, drilling analytics, and the muscle memory of crews who know what it means to work underground at high temperature and high pressure. The politics of that are almost too neat. A large part of Washington currently in power is hostile to renewables until the renewable project arrives wearing boots from the shale patch. Then, suddenly, everyone wants to talk about energy dominance, domestic supply chains, and workers in hard hats. Fine. Build the megawatts. The grid will not refuse a clean electron because the rig crew used to drill for gas. Fervo was founded in 2017 by Tim Latimer and Jack Norbeck. Latimer had worked as a drilling engineer. Norbeck came from geoscience and reservoir work. The company started with a bet that the shale era had changed drilling enough to make a new class of geothermal projects possible. That bet had its first serious public proof point at Project Red in Nevada, built with Google. Project Red is small, around 3.5 megawatts, but it produced the kind of test result the sector needed. A horizontal well pair, hot enough rock, controlled flow, 63 litres per second in the 30-day test, and an operating project feeding clean power onto the grid serving Google's data centres. A 3.5 megawatt project will not change the US power mix by itself. It can change what lenders, off-takers, and engineers believe is possible. In infrastructure, a small working asset often beats a giant slide deck. The slide deck needs a coffee break. The asset needs maintenance logs. Cape Station is the real test. Fervo's Utah project is planned as a 500 megawatt next-generation geothermal development. Phase 1 is expected to deliver first power in 2026 and reach about 100 megawatts by early 2027. Phase 2 is aimed at taking the project to 500 megawatts by 2028. That is a serious power station. A 500 megawatt geothermal plant running at a 90% capacity factor would generate around 3.9 billion kilowatt hours a year. That is a very different proposition from a demonstration project in Nevada. It also tells us why the IPO matters. Fervo is moving from venture-backed promise into heavy infrastructure delivery. The company needs drilling campaigns, turbines, wells, roads, grid equipment, PPAs, tax credit planning, insurance, project debt, and enough corporate capital to keep the machine moving while the subsurface data comes in. This is where geothermal finance gets hard. The fuel is free once the plant runs, but the early money gets eaten by exploration, drilling, confirmation wells, reservoir modelling, surface equipment, and long lead procurement. A geothermal project spends money before it has the comfort of proved resource and operating cash flow. That funding gap has boxed in geothermal for decades. Good physics, difficult finance, plenty of heat underground, not enough lenders willing to pay for the messy first steps above ground. Fervo's IPO does 3 useful things for the sector. It gives Fervo a bigger balance sheet. It gives public markets a clean geothermal benchmark. It gives other developers a signal they can take into meetings with funds, utilities, banks, and strategic buyers. The effect reaches beyond one company. Once a public market price exists, private capital has something to compare against. Once non-recourse project debt enters a first large EGS project, lenders can begin writing internal playbooks. Once Google, Southern California Edison, Shell Energy, and community choice aggregators are attached to contracts, off-takers can stop treating geothermal as a science project with a nice logo. Cape Station's $421 million non-recourse financing for Phase 1 is especially important. Non-recourse debt means lenders are looking at the project itself, the contracts, the engineering, the construction plan, the tax credits, the resource evidence, the downside risks. They are lending against the asset, rather than relying only on the corporate parent. That is how a technology moves into infrastructure. The bank stops admiring the idea and starts asking about default scenarios. Now, we should quantify the current baseline. In 2025, the US generated about 4.5 trillion kilowatt hours of utility-scale electricity. Renewables supplied about 24% of that. Geothermal produced less than 1% of total utility-scale electricity and about 2% of renewable electricity. The installed geothermal power base in the US was about 4 gigawatts in 2024. That was spread across 99 plants, heavily concentrated in the western states. California alone carried most of the national capacity, with Nevada a distant second. So when Fervo talks about a 500 megawatt project, that is small compared with the full US electricity system and large compared with the current geothermal sector. Cape Station alone would add roughly 13% to the installed US geothermal capacity base recorded in 2024. Fervo's signed PPAs are reported at 658 megawatts. At a 90% capacity factor, that would be around 5.2 billion kilowatt hours a year, roughly 1/4 of current US geothermal generation by our calculation. Fervo's 2.6 gigawatts of advanced stage projects would produce about 20.5 billion kilowatt hours a year at the same capacity factor, close to the current annual electricity output of the whole US geothermal sector. Then there is the early stage pipeline. Fervo has talked about more than 38 gigawatts in early development. At a 90% capacity factor, 38 gigawatts would generate about 300 billion kilowatt hours a year. That number needs caution. Early stage pipeline is not built capacity. Some sites will fail, other contracts will not land. Wells will disappoint and permits will drag. Many grid connections will become the usual American hobby, waiting for an interconnection study like it contains the secrets of the pyramids. Even with that caution, 300 billion kilowatt hours a year is a serious figure. It would be roughly 7% of current US utility-scale electricity generation, not to mention more than 1/4 of current US renewable output. One developer's early resource funnel is now large enough to belong in the national power conversation. The Department of Energy's wider numbers are even larger. DOE analysis says next-generation geothermal could expand the available US geothermal resource from around 40 gigawatts under conventional limits to more than 5,000 gigawatts. The same work points to 90 gigawatts of economic deployment by 2050, with a high case above 300 gigawatts, where technical and market conditions move in the right direction. Run the 90 gigawatt case through a 90% capacity factor, and you get roughly 710 billion kilowatt hours a year. Against the 2025 US utility-scale power system, that is about 16% of generation. Against a 2050 US power system, growing from today's base at EIA's projected long-run range, it would still be roughly 11% to 13% of total electricity consumption. That is the scale of the geothermal prize. A technology that barely registers in today's US generation mix could become a double-digit share of a much larger electricity system. The 300 gigawatts high case is much bigger. At 90% capacity factor, it would be around 2.4 trillion kilowatt hours a year. That would be more than twice current US utility-scale renewable generation. Nobody should treat that as guaranteed. But it is large enough to change how utilities plan firm capacity, how data centers contract electricity, and how oilfield service companies think about their next decade. Truth is, US electricity demand has broken out of its long flat period. EIA says it has risen by an average of around 2% a year over the last 5 years, after about 15 years of near stagnation. Its short-term forecast puts consumption near 4.25 trillion kilowatt hours in 2026, up 1.3%, then up another 3% in 2027. Yes, that's trillion with a capital T. The commercial sector is the driver, and data centers sit inside that commercial load. Manufacturing is adding demand. Electric vehicles and heat pumps add more over time. Sustainable electrification now sits inside power stations, grid queues, transformer supply, and firm capacity contracts. That is why Fervo's IPO landed. The market can see the bottleneck and fears that age-old supply-demand imbalance that drives prices higher. Power demand is rising, clean electricity procurement is becoming hourly and physical, and utilities need capacity that helps with reliability. A clean, firm megawatt has system value. A geothermal megawatt also has a different financial profile from wind and solar. Wind and solar have lower energy costs in many regions. but they depend on output profiles, storage, curtailment, transmission, and market shape. Geothermal has heavy upfront capex and drilling risk, then very low fuel risk. A lender can understand and can price that. They may grumble, naturally. Grumbling is a lender's version of cardio fitness. The cost curve is the next test. Fervo's filings and market analysis put current project costs around $7,000 per kilowatt, with a long-term target closer to $3,000 per kilowatt. At the higher end, geothermal needs premium offtake and strong tax credit treatment. At the lower end, it begins to look like a major clean firm competitor, especially where gas price volatility, emissions exposure, and transmission scarcity bite. The path down the cost curve runs through repetition. Drill more wells, shorten drilling time, standardize power blocks, improve reservoir models, use better downhole data, buy equipment at scale, move from custom project to repeatable project. That is exactly why public equity has such an impact. A company cannot reduce geothermal costs in theory. It has to drill, test, fail in small ways, learn, and then drill better. The market is funding repetition. There are risks everywhere. Reservoir performance has to hold. Induced seismicity must be managed with discipline. Water handling is required. Permitting can drag. The Western US resource base can be far from the best load centres. Transmission is never a footnote. It is often the whole paragraph, written by a committee and stamped 3 years late. Fervo also has customer concentration questions. Google is central to the story, and the Google Framework Agreement gives the hyperscaler a structured route into future offtake. That helps Fervo because a buyer with huge load and serious credit quality reduces market risk. It also gives Google influence over the development path. Large buyers can lower financing costs and box in a developer at the same time. Developers love anchor customers until the anchor starts rearranging the deck furniture. For the wider market, hyperscalers are becoming architects of power supply. Google, Amazon, Microsoft, Meta, and their peers have made climate commitments, built giant load curves, and discovered that local grids do not expand because a cloud executive wants them to. They are now leaning into generation, offtake design, project finance, and site strategy. The cloud has found the substation, yet the substation is left unimpressed by branding. This is the right place to bring in Washington. The current US federal policy environment is openly hostile to wind and solar. The White House has used language that paints wind and solar as unreliable, expensive, ugly, and foreign-controlled. Federal actions have added extra political review to wind and solar permitting, and courts have already pushed back against some of those barriers. The policy package has also treated technologies differently. Wind and solar have faced accelerated tax credit pressure, while geothermal, nuclear, and hydropower have had a more favourable pathway in parts of the legislative process. That is not energy neutrality. That is political sorting. For us at Synergy International, the blunt reading is this. US politics is trying to turn technology choice into cultural signalling. The market is looking at demand, contracts, credit risk, and delivery dates. The market is not morally pure, but it can count. Anyone trying to read the future of sustainable energy capital should spend more time watching the market screen and less time listening to speeches from politicians still emotionally invested in 1978. Washington cannot repeal load growth. It cannot make data centers run on slogans. It cannot make gas price volatility disappear by calling it freedom. The Fervo IPO is a clean reminder that sustainable energy finance still has depth when the commercial case is strong. Investors did not buy Fervo because the US government has become kind to renewables. They bought because clean, firm power is scarce, data center demand is real, and geothermal has a plausible route from niche resource to infrastructure category. That is the lesson for our GreenWave listeners. The US political noise is loud, and it can distort the view from this side of the Atlantic. Look at the capital flows as well, and where hyperscalers are contracting. Pay attention to which technologies can raise equity and which projects can raise non-recourse debt. Europe has its own geothermal opportunity, especially in district heating, industrial heat, sedimentary basins, mine water systems, and power generation where geology permits it. Many European countries are still too slow on permitting, too cautious on drilling risk, and too fragmented in support schemes. We know the routine. A public authority holds a consultation. Another public authority studies the consultation, and by the time anyone drills a well, the heating network has developed trust issues. Europe should pay attention because the US may start pulling equipment, talent, drilling capacity, and investment attention into geothermal at pace. Oilfield service companies will follow revenue, and turbine suppliers will not be far behind. Geothermal also gives Europe a useful political story. It is local. It can provide heat as well as power. It can use subsurface skills from oil and gas regions, reduce gas exposure, and support district systems and industrial clusters. It can sit below ground without creating the same visual fight that has slowed wind in parts of the continent. But as anyone who ever tried to finance a European green hydrogen project knows, good politics will not carry weak projects. Geothermal still needs resource data, public risk sharing, proper permitting, drilling insurance, experienced operators, and offtake contracts that pay for firmness. The glamour ends quickly when the well underperforms. That is why Fervo's success should be read with discipline. A hot IPO is not a completed power plant. A big valuation is not a guarantee of reservoir performance. A strong debut does not cancel capex risk. Markets can overheat. Clean tech has seen this film before, and some of the sequels were expensive. Fervo must now do the hard work in public. Deliver Cape Station. Keep drilling times down. Hold reservoir performance. Convert backlog into revenue. Bring costs down without hiding risk in accounting fog. Keep communities on side. Manage seismicity, connect to the grid, make the turbines turn. Those are the milestones that will decide whether the IPO becomes a sector opening or a fashionable trading week. Public markets bring money, but they also bring quarterly pressure. They give a developer currency, then hand it a stopwatch. The deeper point is larger than Fervo. Sustainable energy capital is becoming more selective. The easy story is gone. Developers now must show customers interconnection, financing, supply chain control, and a route to margin. Decorative climate claims are being stripped back. A certificate bought after the fact will not power a server hall. That is healthy. It favours real assets. It favours builders. It favours companies that understand lenders, grid operators, off-takers, insurers, and communities. It punishes lazy sustainability theatre, which for us at Synergy International is no bad thing. Geothermal fits this harder market because it is physical. Hot rock, wells, pipes, turbines, brines, transformers, PPAs, debt service, real failure modes, operating logs, and capex. There is a certain comfort in that. After years of vague energy transition language, centres can run on cleaner, firm electricity. It is beautifully unsentimental, almost rude, the balance sheet version of a hard hat. The US sustainable energy sector is still resilient because the drivers are stronger than the politics. Electricity demand is rising. Clean procurement is becoming more exact. Corporates still need credible emissions pathways. States and utilities still need capacity. Customers still pay bills. Lenders still look for contracted cash flow. Developers still chase margin. federal government hostility can slow deployment and raise financing costs, it can also damage projects and waste years. Yet, despite all the hot air at the top, it cannot remove the commercial need for power that is clean, firm, and financeable. That is why we should treat Fervo's IPO as a market signal worth hearing. The signal says geothermal has moved out of the polite side room and onto the main capital stage. Investors believe the US power system needs new, clean, firm supply. Sustainable energy still has buyers, even when Washington is busy performing for the fossil balcony. The next few years will be the proof. If Cape Station works, geothermal developers everywhere will walk into funding meetings with a different posture. If costs fall, utilities will have a stronger, firm, clean option. If the drilling repeatability holds, the oil and gas service sector may find that part of its future is cleaner than its past. And if Fervo stumbles, the sector will still have learned something useful, but the cost of capital will bite. That is the bargain of public markets. They fund ambition, then punish excuses. Well, that's a wrap on our 71st GreenWave podcast episode. Thank you for spending your time with us, and we hope you've gained some insight into the geothermal situation. Find the GreenWave podcast on Apple Podcasts, YouTube, Podbean, Spotify, iHeart, Podchaser, Boomplay, and Player FM. Please follow the show, share it with colleagues, and leave us a review if today's episode helped sharpen the conversation. You can also keep up with Synergy International on LinkedIn, Facebook, and Instagram, and through our website at synergy-international.net. Until next time, keep riding the green wave of sustainability.